So what I'd like to talk about is long-term investment in Europe. That was the project and what we looked at. But really from one specific point of view, and that is the listed real estate sector. Okay? And in particular, we'd like to talk about long-term investment with regard to one aspect, which is how do you transfer assets from an unwilling holder, which we'll describe as, say, banks or the government, or in the case of the UK, they're the same thing, from an unwilling holder to a willing holder in a proper, efficient vehicle. And what I'd like to call upon as evidence, sounds like a courtroom, doesn't it, really? But call upon as evidence are 3 reports we've done at EPRA. So these are 3 research reports, and what I want to do is to just go through them very, very briefly. I know how exciting research reports, particularly academic ones, are to people at a conference like this, but just going through them fairly briefly to put a few thoughts out there for you as to how we can affect this transfer of ownership and the role of long-term investment in Europe from the listed real estate sector. So the reports relate to the relationship between listed real estate and direct property. And the contribution of the listed sector. Listed sector is quite often pilloried in the press for various reasons, but in fact it does make a huge contribution to the overall economy. So I just want to highlight that. And then, finally, I'd like to end up by looking at lessons we can learn from the growth of the US. And the reason for that is, as we shall see, the US saw dynamic growth. And actually, if we look at the lessons from there, we can see how Europe may be able to grow in the listed sector. So, what do we know and what don't we know? Well, we do know, well, I hope we know, that in the short term, listed real estate performs like equities. 2% a day movements are not uncommon. And in fact, at the height of the fun and games in 2008, it was up to 5, 6, 7% a day. And some people, quite understandably, complain that that doesn't really reflect the long-term performance of real estate. And of course, they're right. But the research we found is that over a 3-year period, absolutely the returns converge. So listed real estate can be seen as a way of participating in long-term real estate returns, and we should take that as a given. However, the research we did with IPD shows one or two important points here. And that is, people get concerned about the volatility of listed real estate. But if you actually take a transaction-based index, what you find is that that difference in volatility is far less than previously shown. So what I'm trying to reassure you is you shouldn't be concerned about the volatility of listed real estate. If you look at a transaction index, volatility goes up dramatically compared to a typical valuation index. In terms of the lead-lag relationship, I think we're all aware that the listed sector leads the direct market. What they found was that actually the lead is not because the listed market is looking forward and the direct market is looking backward, and it's therefore not due to valuation smoothing. Now, this may come as a huge surprise to a lot of you, but not all of the countries in Europe are the same. It happens. And in the UK, what we find is we tend to be far more cyclical as a real estate market, and therefore the lead between the listed sector and the direct market is between 0 and 2 quarters, whereas France, Netherlands, Sweden, it's 2 to 4 quarters. Now, the last comment will surprise absolutely nobody, and that is that Germany and Switzerland are different. And the reason for that lies in the fact there's little correlation between the direct market and the listed market, and indeed the fact that we have far less evidence of cycles in those markets. So one important thing to think about when we're going forward about long-term investment, are the countries we're looking at for long-term investment, do they demonstrate long-term cycles? If they do, then we have the opportunity to invest, either through distressed debt, distressed asset purchases, etc. If we have no evidence of cyclical behavior, it's very hard to capitalize on that. So that's the first research report I'd like to leave you with, the relationship between the listed sector and the direct market. And in particular, bear in mind those thoughts about the difference in the countries between the lead and the lag, because we're coming onto that later. The next report, and this might seem a little bit self-serving, but is about the contribution of the listed sector. And one of the interesting things about that, if you look at the period up to 2007, there was broadly little difference in some of the returns between listed and unlisted funds. And the reason for that was that the direct market was showing huge levels of growth, fueled by expansionary debt policies, and there's little difference. However, post-2007, there's an enormous difference, and one of those key things was the listed sector was able to recapitalize. Okay, the unlisted sector is unable to recapitalize. Now, as a result, the listed sector is now going ahead as if there was no problems whatsoever. And what it means is that it's been able to actually innovate and lead the sector forward in a number of areas. The first one is very much in terms of sustainability. The reality is, it's very hard to worry about sustainability when you're worried about your bank manager asking to call in your loans on a daily basis, as some of the funds have. But the listed sector is able to actually provide clear leadership in this area, and in fact, most of them comply now with a number of new sustainability ratings. In addition to which, the EPRA promotes a high level of clear corporate governance and transparency, and those have been taken up by the unlisted sector as well. And finally, I would say that it provides the liquidity you can't see elsewhere. So in terms of the contributions, it's not just a subsector of the real estate market, it's actually providing the way forward in a number of areas. So let's come on to the meat and potatoes, or the mulfried of the entire session. And so if we look at Europe, we know that the sector has declined. Do we know the sector has declined? Well, I'll tell you it has. 5 years ago, the European listed sector was 25% of the global listed real estate sector. Anybody like to guess what it is now? As a percentage of the global market, it's gone from 25 5 years ago to 12, sadly. Well, a pause for a moment there whilst we think about that. 25 to 12. So broadly speaking, a quarter of the global market to bordering on insignificance, sub 10%, or materiality. Okay? That's something we need to think about. The other thing we need to think about is what percentage of commercial real estate is actually in the listed sector, okay? And we call that the level of securitization or equitization. Now, this is important because in certain markets, the amount of commercial real estate in the listed sector is around 5 or 6%, okay? In Europe, it's much closer to 1%, and in certain countries, it's even less than that. Why is that important? It's important because if we're looking at long-term growth and long-term investment, it means that the way to transfer assets from unwilling owners to willing owners is by taking them from the banks and taking those assets and putting them in a listed format. And by definition, a lot of the European countries are underrepresented in the listed format. Okay, so that's very important. So we're going to look at 3 brief points. Firstly, the weightings. And this is a piece of work that we put out at the end of last year. That relationship between the UK and Eurozone, we're actually, this 10% is below the normalized weighting. It should be higher. So if we look over the long term, it should be higher. However, as I said, we have been able to recapitalize quite significantly. And so the ways that the company sector grows are by asset value growth, share price growth, and of course, new equity issuance. And we're starting to see the beginnings of that. In terms of the big picture, how much is it undercapitalized? Well, we did some work, and we estimate that if we were to take the European figure and bring it up to a more normalized rate relative to the rest of the world, it would require an increase of about 200 billion US dollars, okay, to bring it in line with the global average. Now, that's a nice big figure to think about, and then the next thing we have to think about is how we get there. But broadly speaking, it's very important to see we are undercapitalized as a European listed sector, and therefore that has to be part of the way forward. So, the parallels we looked at were the growth of the US market. Now then, if you want to look at something, if you want to be really depressed, in 1989, and I know you don't want to be depressed, but I'm setting up so you'll be happy afterwards. In 1989, the UK listed real estate sector was larger than that of the US. Okay? It was larger than that of the US. And it's fair to say that that didn't last very long because, and I'll go through the reasons why the US market grows so much, but it basically went from 6% of the global market to 46%. Why do I make that point? Because it's the case that it's not so obvious that a market will always be dominant. The US commercial real estate market has always been very dominant and had a very high weighting, But if we go back to 89, the US REIT market, and let's not forget, REITs had been in operation since the early 60s. So the US REIT market was smaller than that of the UK. Okay? And in a 2-year period, in particular, and we'll go through the reasons why, it was able to grow dramatically and now represents 46%. Why is that important? Because that's how the listed sector can transform through a combination of government regulation and market forces and transfer of assets into the listed sector. So, what criteria do we need and why did the US succeed? Well, the first thing it had was modern investable commercial real estate stock. You cannot possibly have a listed real estate sector of any decent size or scale or credibility unless you have the underlying real estate assets. Okay? We had that, obviously, in the case of the US and the demise of the real estate limited partnerships, which are predominantly, for those who are interested, it was the way that people tended to invest in commercial real estate prior to 89 via these tax-efficient limited partnerships. So we had the real estate stock there. There was also the case that there was some regulatory change which meant that the debt capital markets opened up. Now, I'm sure you're aware, but at the moment, debt capital markets for a listed company have never been better. There are companies who can raise debt capital long-term at between 2.5% and 3.5%. So for a property person, if you can't make money when your debt capital is 150 basis points below the initial yield on your building, then I think you may have a few questions to answer. All right? So we have that at the moment here. And there were also changes in the tax laws, and this is a key point. For these markets to grow, you need a combination of governments plus market forces for it to work, and one or the other on their own won't be sufficient. So let's have a look. These changes meant that people were free to invest for the first time. The big change was allowing institutions to invest in REITs, and also for vendors to not suffer tax penalties. In fact, there's a thing called the UPREIT, which was the way they were able to sell efficiently. And so basically, if you can transfer assets, a key point here from a legal framework, if you can transfer assets from private ownership to public ownership without incurring hideous tax charges, guess what? It's a good idea, and you get that transfer of ownership, and it happens smoothly. This is very key because one of the REIT markets that hasn't developed in the world is the Hong Kong REIT market. And the reason for that is very straightforward. It's because Hong Kong has a fairly light tax regime anyway, and the marginal tax benefits are quite small for converting to a REIT. Whereas over here, with ingrained capital gains tax liabilities, the benefits to changing to a REIT status were very large. So, as we can see, tax efficiency to inject assets into the listed sector is absolutely key. The next point is absolutely vital as well. There was a structural imbalance. Institutions were underweight REIT holdings. They only had a weighting of about 2%, and their overall equity holdings were 4%. Therefore, they needed to double their holdings as a structural change, and they had to double their holdings to match their general equity weightings. Why is that relevant? Well, at the moment, real estate is very much in the hotspot. Everybody wants to increase their real estate allocations. I was at a meeting yesterday, and some have increased from 2.5% to 5% of their overall weightings. Others are increasing from 5 to 10. There's a piece of research out by Brookfield which suggests that weightings in real assets in general will go from 10 to 20, 25% over the next 5 to 10 years. Okay? This is part of a broader trend. One of the key things is, if people are going to increase their weightings to real estate in general, guess what? That means long-term investment. And guess what? If they want it in a liquid form, that's the best way that they can get it in terms of transparency and liquidity. So the final point there in terms of the growth of the market was that there's sufficient momentum. All these things are fantastic, but if there's not sufficient momentum, they don't carry on. There's sufficient momentum to allow the recently IPO'd REITs to have follow-on issues. The key thing is to be able to continue to raise capital. As I'm sure you're aware, REITs have to distribute 90% of their income. Therefore, by definition, there's no retained profits. Therefore, they have to keep on refinancing. So it's very important to have a continuous access to the capital market. So did we find that that was the US story? Did we find that there are any parallels there? Well, I think we can say there are. There's undoubtedly the pool of assets in Europe. to support the similar levels of growth. But as we've seen in the numbers, it's not in the listed sector now. It's in the hands of the banks, it's in the hands of unwilling holders. So we need to effect that transfer. The debt markets, as I mentioned, could not be easier for the companies at the moment. It is very much the case that the US and the French REIT models, and the reason I'm talking about REITs is because governments have the ability to change REIT legislation at a very short notice, and therefore that can change investment attitudes. The UK and the French models are quite well known, and there's been certain tinkering with them to improve them. But it's also the case that elsewhere in Europe, they're not well known, and they need a bit of fine-tuning. It's also true, I was talking about underweight, equity investors are not structurally underweight, but what they could be is structurally underweight the allocation. And there's a subtle difference. So it's the overall real estate allocation that's going to go up, in my view, not the specific allocation to REITs there. So where is this growth going to come from? Well, in the UK, we have seen that there was the abolition of the conversion charge, and what we have seen is an increase in interest in the sector. Valuation is a point that I haven't mentioned here, but in terms of the UK, we are now trading at a premium to NAV, well, the largest companies certainly are, which is the first, which shows the success of the sector and the ability to raise future equity finance. So the UK is absolutely a case where we should see more coming through. Germany. Germany. What can we say about Germany? I think speakers coming forward will talk more about the nascent sort of REIT market and how that was almost killed in its tracks with various moves on the tax side. But what we can say is there's a clear parallel between the amount of assets held in open-ended funds in illiquid structures and the amount of assets that could be transferred into liquid structures. Okay? And there's a parallel there with what happened in Australia. So Germany overall would be the main area where we could see huge growth in terms of transfer of assets to the listed sector. Italy and Spain are countries which have negligible assets in the listed sector. There are those who might argue they've got negligible assets in the real estate sector, but that's unfair. But if anybody wants to buy my house in Spain, I'd like to speak to you afterwards. So there are assets in there, in the commercial real estate market, which can be put through. And in particular, what I would say about some of these markets, it is up to the governments to actually transact a sufficiently large pool of assets to transfer to generate that critical mass and get the market moving. And that is where we see that there may be the big shift. So, in conclusion, we're all fantastic. Real estate's a vital part of the economy. That's marvellous. But what I would say is at the moment, you do see these long-term cash flows and inflation hedging qualities making the sector absolutely in a sweet spot of investors. And therefore, it's absolutely imperative that we capitalise on that investor interest, which is expected to continue for the next 5 to 10 years, to effect this transfer of ownership. And that those inflows to the sector are channeled efficiently. And to do that, we need not just market momentum, but also the help of government legislation. And the opportunity exists for these governments and the EU to deliver the policies and effect that change, to take those assets from taxpayers' unwilling holdings to a healthy and strong and larger listed sector in particular. Thank you very much.